Until now, we've talked about the qualitative factors behind equity's growth. Now, let's throw some light on the quantitative aspects. This graph shows the earnings per share of Nifty from the year 2001 until 2017 and the forecast for the years 2018, 19 and 20. From 2001 until the beginning of 2008, the underlying companies grew at an astounding rate. Thus, Nifty registered an earnings growth rate of 21% over these years, despite a poor beginning in the initial 3 years. The next phase began with one of the worst global slowdowns, followed by an amazing recovery in the next 6 years. During this period, Nifty registered an overall earnings growth rate of 4.5%, after providing for the 2008-11 losses. During FY 2017, the Nifty registered an earnings growth rate of just 6%, but the years to come are expected to remain bullish, and the Nifty is expected to grow at around 19% over the next 3 years. This graph again testifies the fact that equity markets will keep on rising and falling, but over the long term, they will deliver stable and good returns. And this is because the price of a share is dependent upon the underlying company's profitability. Next we have the Sensex projection after 5 years. We discussed in an earlier video that the price of a company is a function of its earnings represented by the EPS and the willingness of the buyers to pay, that is the PE ratio. Extending the same logic to the Sensex, we have forecasted the Sensex value under different EPS and PE scenarios. This analysis pertains to 5th September 2018 when the Sensex value was 38,018 and the EPS of the underlying companies was rupees 1525. So on the basis of this current EPS of rupees 1525, we arrive at the projected EPS of the Sensex after 5 years under different growth scenarios, that is 15%, 18% and 20%. We also have 3 different PE scenarios for the Sensex, 15, 18 and 20 times. We have seen in the video Basics of Equity that the average PE of the Sensex since its inception has remained at around 20. Now if for these 5 years the average PE remains 20 and the underlying companies of the Sensex grow at an average rate of 20%, then the value of the Sensex after 5 years will be at a little less than 76,000. This in our case is the best case scenario. That is, the underlying companies are also growing and the market sentiment is also positive. Now let's consider the worst case scenario. Let's say the PE of the Sensex for the next 5 years remains at around 15 and the underlying companies also grow at a modest rate of 15%. So in the worst case scenario also, the Sensex will be valued at around 46,000 after 5 years. So to conclude, we talked about the economy, the growth prospects and how the economic growth is linked with equity. Now the stunning growth stats that we discussed were of the Sensex. And we are not investing in the Sensex because we are investing in a more refined version of equity. We are investing in mutual funds. Sensex, as we all know, comprises 30 large, well-established and financially sound domestic companies which are listed on the BSE and are representative of all the key sectors. A mutual fund, on the other hand, can comprise any company of any size which is fundamentally strong and is capable of yielding good growth in line with the investment objective of the scheme. A mutual fund scheme can invest in any number of companies based on the wisdom of the fund manager. The aim of a mutual fund is to maximize the return and minimize the risk of the investor. This graph shows the return comparison of the average of diversified equity funds represented by the blue column, the Sensex represented by the orange column, and the Nifty represented by the yellow column. Over the years, Diversified mutual funds have outperformed the major indexes by wide margins, which is visible in this graph. So the crux is, India is a land of opportunity, and what the investor needs to do is exploit this opportunity the maximum to his advantage by investing in mutual funds. And that was all about the topic projected earnings. Thank you.